Thank you, Mr. Minister, for your very encouraging words for our sector. Let's move on to panel number 2 on the following. The insurance sector, is it an essential safe haven in an uncertain world? I call Mr. Recaredo Arias, Mrs. Mirenchu del Valle, Virginie Fauvel, Mr. Felix Hufeld, and Thierry Martel will be our MC.
Bien, bonjour, bonjour à tous.
Good morning. I'm the CEO of the Groupama group, and I'll chair also the association of the mutualist insurers. It's my pleasure to MC this round table. The insurance, is it an essential safe haven in an uncertain world? Mr. Aroma has set the scene by highlighting two major issues, such as, on the one hand, digitalization, and on the other hand, climatic change. The political framework has been set. I think we are trying to find pragmatic solutions with regulators. This is really some music to our ears. I hope that these ideas will move forward and that they will thrive. After setting up this political context, let's look at the ground and how operators day in and day out experience such challenges, and what are the constraints that should be lifted perhaps in order to better, I would say, play our role as people and companies who secure risk in these societies who are increasingly volatile and where trends and developments are very rapid. English now.
Mr. Recaredo Arias, President of GFIA, Global Federation of Insurance Association, and Director General of the Mexican Association of Insurance Companies. Mrs. Mirenchu del Valle Schaan, I hope my pronunciation is good. Secretary General of UNESPA, the Spanish Insurance Association. Madame Virginie Fauvel from Euler Hermes. She's member of the Board of Management, Chief Transformation Officer, Head of the Americas. And Mr. Felix Hufeld, President of BaFin, well known, I think, in this room. Thanks for agreeing to participate in this conference. My first question will be for you, Recaredo Arias. Drawing on your broad background in leadership and your expertise of the industry, can you give us some insights on how digitalization is transforming the insurance industry? From which industries can insurance learn with respect to digital transformation? And please, in 6 minutes maximum.
Okay. Yes, I will not do a wide conference on it.
I'm very honored to be invited here. Now moving to English again.
So many people nowadays think that the essential part of the insurance industry, which is the transfer of risk, will remain the same, even though we are facing huge technological advances. But I think that, and some people says, and I have been in the last weeks in Ireland and in other places, also in Mexico, where some people says with this regard that there is a lot of beer color in the glass, but there are a very little bit of content, of real content. And all of these people that think in this way, in my point of view, will face, in the case of insurers, the lobster syndrome, the lobster effect, which means that the lobster has been boiling. They are warm in some manner, and then they feel comfortable, and then they say, this is okay, this is perfect, and I will remain this way. I think that, of course, they will lose. And I think that as a market, as insurers, we have to create the digital transformation, and we have to create the disruption from inside, and we have to avoid that the Big Four will come and create the disruptive model. Or maybe it can be Schaan from Hong Kong and China, which are having big advances. Then, in my point of view, I think that in the next 10 years, the insurance industry will change more than it has been done in the last 100 years. Then we have to accept this challenge, and we have to work in order to adapt and adopt the new technologies. Of course, the impact will be done in all the parts of our insurance model, in our business model. We will be affected, or we have three big challenges in the three most important parts of our business. The first one is distribution, in which, of course, we will have to use all the data analytics or the data science, in order to take this information inside the company and outside the company, because even though all the regulations, we have so much information, and then we have to create products that fits for purpose for the specific needs of the consumers. On the other hand, we have digital tools that will provide us with very important information. For example, the telematics and the wearables on all of the other things that we are having in order to create better products for the customers, and of course to let him live the customer experience, the consumer journey, because nowadays we as insurance cannot be relaxed in order that we sell the insurance policy. We wait that they will have a loss, and then we wait to the reinstallment of the insurance policy. We have to interact with our consumers, meanwhile the policy is in force. On the other hand, blockchain. Blockchain is a very powerful tool that we have to use. In Mexico, we have an agreement, we have a joint venture with IBM, my association, the Mexican Insurance Association, with regards of the encryptancy of insurance policies. We will start with the compulsory auto insurance, but we will go to all the chain, and of course the invoices for the claims, because we have so much fraud on those. And we will continue with all the value chain of our processes. On the other hand, as I said, it was the data science to design the products to fit the needs of the consumers. And in this case, we have three applications that are going and has been digitalized in a very important manner and in a very rapid manner, in motor insurance, in property insurance, and in health insurance. In those cases, we have greater choice and more tailored products. And in the other hand, we have we are incentivizing better conduct from the part of the consumers. For example, wellness in the case of health insurance, or for example, better habits for the driving conduct and such kind of things. And at the end, in order to don't consume more time, we have the regulatory considerations. Maybe we will talk in a deeply manner later, but in any case, we have a challenge here, because we have to avoid new regulation for the specific transformation and for the challenges that represent digitalization. But on the other hand, in my point of view, we think that we have to enhance and we have to to facilitate, in the case of insurance companies, in the case of startups and all the innovative initiatives, we have to incentivize those throughout the regulation. Mostly, if we are talking with regard of all the insurtechs that are going to facilitate the distribution of the insurance products, or on the other hand, that will facilitate the process of the companies. And in the third part, it is the carriers of risk, the digital carriers of risk that are outside of the regulation. I mean, the insurtechs that takes risks, and in this case, I think that the regulation has to permit them under a sandbox model, and we have in Mexico a fintech law with a secondary level regulation that permits that, and then to allow them to do that for 2 years, for example, and after that, they have to become regular insurance companies, taking in consideration the principle of same rules for same activities.
Thank you very much. Madame Mirenchu del Valle.
Mrs. Mirenchu del Valle
and Consulting. As an insurance industry representative, what do you think are the main challenges concerning new risk emergence and old risks evolution that insurers are facing in the 21st century?
Enfin, merci, je suis ravie d'être parmi vous.
I'm delighted to be here with you. It's very clear that societies are evolving and the risks that our parents underwent are different now, but social economic progress, we're not able to dispel risk. Some risk disappeared, but others are being still there without us being in a position to diminish their violence. And progress opens the gate to new risks. So I'm starting by saying that there will always be risks. That's a good piece of news. We can always do business. It's good to be aware that we will always have that open gate or open door. I'd like to make a slightly disruptive comment. There are 3 aspects that I would like to go over. Some were dealt with in the first one, others might be dealt with this afternoon. First of all, I believe that the insurance business should play a major role in the face of the main challenge in the 21st century, which is the aging of population and its effects on the viability and the fit of the public systems as they relate to pensions. We can see a trend in societies towards saving little and usually saving in products with a defined contribution, and savers take financial actuarial risks without knowing them very well and without understanding them well. And this raises a challenge for the insurers. So we should put into the market protection systems with some kind of cover. I mean, we're talking about bringing some certainty in an uncertain world in a context of interest rates that are low or even negative. We could even say mission impossible, quote unquote. We'll see later on. Now, secondly, the states, the governments, which might also take decisions, implement reforms in regard to public systems and reforms that are not popular. And in that low interest rate environment, they might have to push back their decision up to the next election period. And the third one is a challenge for the citizens, who are also requesting solutions to avoid the risk of surviving to their own savings. And there we'll have the PEP, and we would like, as insurer, put onto the market a solution that provides certainty in a field which is uncertain, and because most Europeans don't know what will be the public pension that we will be obtaining going forward. The second challenge flows from digitalization, and in that case, I see very positive aspects for the insurance business. We could have a closer contact with the policyholder, more on an ongoing basis. We could put in place simpler products, and this also raises the question of the soaring of new risks, such as cyber risks, and in that case we are facing global risks which go beyond borders, and this leads to the question how we can insure such cyber risk. And the solution requires sector-based inter-sector cooperation with public national administrations and European ones. As we said before, I think it was in the previous panel, it was said that we need information. We need to know more about the IT attacks, how they took place, in order to put in place preventative measures, to put in place as well products or insurance products. And in this context, we also need regulation that allows us to pool together data. I'm referring here to the European regulation as regards competition. And the third element is related to our business, to protection, coverage, our role as institutional investors. We are in a global world which is exposed to global risks, and among which we have talked about climatic change. And in that case, we insurers have a say, we have a lot of information. We cover natural disasters. In Spain also, we covered terrorist risk. We have experience, we can contribute in this field, and there are also things that we need to do. This morning, we were talking about our role as institutional investors, as promoters of a transition. We cannot switch off the coal world and switch on the green world. We need to go through a transition, and I think the insurance business can help make that leap and go through that transition. To wrap this up, I believe that the insurance should play a major role amidst all these risks like climatic change, population aging, social changes, and digitalization. It's true that things are changing. Sometimes they are different, sometimes more difficult. Having said that, the role of the insurer is not called into question, and we can contribute some certainty. I'm not talking about political issues here. We can provide some certainty, I was saying, in a field or in an uncertain world such as the one that we are experiencing. So my message is positive.
I will possibly be a bit politically incorrect. In most of our countries, the insurance coverage, the primary one is motor coverage. Do you think you still have a future, motor coverage? Well, in the field of mobility, transportation / mobility, you know, sometimes you totally are at a loss. You go to Madrid city, you walk on the sidewalks, and you have lots of devices on two wheels, you know, push bikes and trottinettes, and you have electric bicycles, and on the other side, on the street, you have the same two-wheel instruments, whatever you call them, who try and share the street with their cars and other vehicles. And in 30 years' time, we'll have, it is said that there will be 30% fewer vehicles in the large cities. Now there's a new policy to share cars. You know, several people using one and the same car. When I was young, you ended up your studies, you finished your studies, and you wanted to have a car. Today, young people are not interested in owning a car anymore. So in the motor insurance industry, it's going to be an issue. We speak about autonomous vehicles. We speak about lots of new developments in this field. So we need to be able to provide an appropriate response, which will very possibly be different from the one we have been providing so far. You won't have the same motor insurance policy to a car and to a push bike or a trottinette or whatever. So we'll have to be creative and adaptive in the field of motor insurance. And there will be at some point when you'll have conventional vehicles coexisting with autonomous vehicles, riding or driving in the same or along the same streets, the same roads, the same sidewalks, and there'll be some types of vehicles declining and some others emerging, and associated with the emergence of new risks, and the insurance providers will have to provide solutions. So I don't see that it will be a loss. It will be right changers, new developments and opportunities. So you're still resolutely optimistic, aren't you? Yes, I am. Madame Fauvel, in an industry which is totally data center, data-based with artificial intelligence and machine learning, there are a host of new opportunities in B2B business, which is your line of business, right? Can you give us some insights and make projections on the way digitizing the industry will proceed in the B2B operations of the insurance industry? Right, yes. I love these annual conferences, I must say. High quality speakers, I'm not talking about myself, but very high quality speakers. And what I'm impressed of when I hear the various speakers is the degree of maturity which comes out, and the fact that people are not naive at all as to how digital technology will impact our business operations. So I'm very much like you. Maybe we are two women, that's why. But I find it very positive not to be naive, yet to be very combative, because we'll have to be conquering combative. So yes, quite positive as it stands. With respect to B2B, now Euler Hermes is the global leader of credit insurance. We provide coverage to goods and property being traded in domestic markets or in the export market. So it's been a sector which has been quite protected from the so-called digital revolution. So we have celebrated our 100th anniversary recently with no major changes in our business model. Now, why is it of interest today? Well, the data which was the gold, the oil of Hermes, Euler Hermes, is no longer our own property. So we are not the only one to hold it and to own it. So we have to keep the one we have, and we have to go and seek and hunt for the data wherever it resides. So we have so-called data hunters. Their job is to basically capture information, open source information, or private data, which sometimes we buy, and you give this data to the data scientist, which parse it, analyze it, looking for value. And if there is added value, then the data is incorporated into the Euler Hermes database. So this is the first shift. The data is no longer owned and held by the conventional incumbents in the industries. You know, it is elsewhere, everywhere, and it has to be hunted for. When you get the data, you have to use it. So how to recruit data scientists when you are an old company, more than 100 years old, with lots of talents, lots of qualities and virtues, but can be heavy, can be old-fashioned in a dressing code, not necessarily of great appeal to young data scientists with possibly not so young computers. I won't mention the computers with this logotype with an apple on it. So how can you attract these younger employees? You have to really change and adapt your organization, make it sexier to attract these data scientists who are on high demand. And how do you retain these data scientists once you've gotten them? Because they are quite a volatile population. population. So we've put together a working environment for these younger data scientists. We called it dress code free, but there is a dress code, of course, but they have computers who are not exactly the same as your regular Euler Hermes employee. We work on the cloud. We give them access to tools and instruments which other Euler Hermes employees don't have. So data and data scientists. Now our clients. In the past, we would make deals over the telephone and using telefaxes. But today, the call of the day is marketplaces. You have Alibaba and Amazon. And who have massively invested the B2B operations. And you have less well-known marketplaces, Metals Up, for example, organizing trading between metal recyclers and buyers. You have AgriDigital, an Australian marketplace, which puts into contact farmers and producers of all kinds of foodstuff and the buyers of these foodstuffs. So the trading is based on the platform. So at Euler Hermes, since we provide a coverage to the selling, the marketing of products, we have to provide coverage where the trading activity is happening. So we have to connect to the marketplaces via APIs and give real-time decisions on providing coverage, yes or no, and at what price. So basically keeping up with our clients, and since these clients have massively gone to these marketplaces, going ourselves to the marketplaces. So major shift, a massive shift. So data, machine learning, and then everything around the platform operations and platforming. Now I have another message. I don't know whether I'll have time to expand on it. It's important that we have in mind that everything about data, about machine learning, there are issues of national sovereignty. This is national sovereignty. This is European sovereignty we are talking about. And here in Europe, we are more regulated than the Chinese are. As a citizen, as a European national, I find it quite well that when I drive my car, some power doesn't know exactly where I am. Now, I would rather keep living this way. And some players are protected and some market participants cannot go into a market and do things which we wouldn't do as Europeans. Now, if the regulators can expedite the way we engage in machine learning, artificial intelligence, data hunting and data usage, we would have everything to win by it, because bank assurance, bankers, insurers, who will survive 10 years from now, though will be the one who will be able to detect the risk using artificial intelligence. How to prepare. Preparedness is a key issue. And on a slightly, so this is slightly less optimistic. Now, last point, how do we retain data scientists in Europe? Every time I go to Montreal, we have French nationals, we have German nationals. I'm delighted that they are here. But I would, why don't they stay in Europe? I would be delighted that they stay in Europe. I was in Hong Kong last week, many French people. Every time I go to Silicon Valley and I hear conferences, I sit on conferences on data sciences, the speakers start speaking in English, and then they go on into French, because there are lots of French people. So with respect to the risk profiles, has it changed the risk profiles? We are finer when we have to operate at a finer level when we use external data, and now we need to have more efficient, more robust models. Now you have fraud cases as issues, of course, who've skyrocketed by using digital technology, and you have to get prepared with respect to cyber security, president spoofing, all this. They are president spoofing cases. Artificial intelligence mimicked the voice of a president to fraud, to defraud a company. So we'll have models, we'll have technology which will mimic the voice, which will mimic the face. So how do you adapt our governance to this? Felix Hufeld, turning to you.
To the risk side, what can insurers do to ensure sustainable development and sustainable finance?
Well, first of all, let me say thanks for having me. It's a great pleasure to be back for the third time now. It's great to be here, and I think it exemplifies and testifies to the fact, both on the industry side of things as well as the regulatory side of things, if Germany and France manage to agree on joint initiatives, it really means something. So happy to be here. I think it's an excellent headline you put forward to that panel. I'm slightly surprised that you added a question mark, though. Insurance is a safe refugee for, I'm tempted to say, hundreds of years in an ever uncertain world. I think people subjectively consider the world to be quite uncertain when they were shipping with small ships across the Atlantic already, and not just today. The reasons why we think it's uncertain are changing, and so we have to adapt constantly. Now, I'm very tempted to add a lot of thinking to some of the big things, and we'll come back to the sustainable question in a second, but being a regulator, please apologize for coming back to the basics for a moment. Being a safe refugee in an uncertain world means very simple things if you're an insurance company. It means keep your promises. If you take risk, which is the very business of insurance, you have to be capable to keep your promise. And that brings us back, straight back to one of the oldest concepts of insurance whatsoever, which is solvency. If we take on long-term risk, we have to be in a position to keep long-term promises. If it's short-term, it's much easier to calculate. So how do we do that in a world where interest-bearing returns are approaching zero or even turning negative? What are we doing to do that? I mean, the simple answer is you have to reallocate portfolios of investments to streams of revenues which are not interest-bearing, which of course increases risk. Secondly, we as regulators, we are forcing the industry to increase their level of resiliency, which I mean, coming from a country like Germany and similar to France, having a very significant book of long-term obligations, even with heavy guaranteed associated with it, this is a matter of survival of the whole system that we get this done. And of course, we have been doing that. And I'm very much with you, Ricardo, that the lobster phenomenon, as you called it, is a dangerous one, because you may think prematurely that it's over with it, and you don't realize that the water keeps boiling, and that's exactly where we are. So the pledge to you would be, let's not forget about the basics, although we rightly so think about green finance, sustainable finance, the whole challenge of digitalization and many, many other things. The good old basics to manage an insurance balance sheet is still as important as it was 10 years ago, 50 years ago, and 150 years ago. If that's been screwed up, you can forget about everything else in a second. Now, to your point, sustainable finance. Well, as we all know, insurance companies are not just taking risk and underwriters, they are a very important portion of what we commonly call institutional investors. So they do have to play a very important role in that. So we've heard from Pierre and others about the importance of taxonomy. I completely share your view that this is a key component to create the necessary level of security. I also share your view that it's an important calibration between offering transparency to make informed choices on the one hand, and not being too prescriptive in detail on the other hand, because quite quickly that could collide with other basic principles, which of course, being a financial regulator, I have to be quite observant. That's exactly the reason. I think Michaela made that point in the first panel, and I couldn't agree more, and thanks for making that point. A green supporting factor, let it be for banks or let it be for insurance company, defined as a principle that anything should be supported or privileged disregarding financial risk is absolutely a no-go. Absolute no-go. So I would tell every politician, whenever I can find him or her, please don't do it. If you do that, I will give you in writing, you're planting the seed for the next financial crisis. That, to me, is the opposite of sustainable finance. So anything you ever do, let it be a general green penalizing factor or a general green supporting factor in the good intention to support something, disregarding risk, don't do it. It's the most dangerous thing you can do. And I don't care whether it's infrastructure, home ownership at the hand of borderline households, green or anything like that, or the flavor of the month, it is utterly, utterly dangerous to play around with the basics of financial stability. So please apologies for being that blunt, but I'm a financial regulator. I must make that point. If I don't do it, nobody else will do it. And so that's quite important. As we speak, Thierry, BaFin has issued a supervisory circular, a legally non-binding circular, I should say. Of course, I know you don't trust them. That might become binding in a couple of years' time, and you might be right in certain points, but currently it's not legally binding. Why are we doing that? We have sent it out a couple of weeks ago. It's under consultation with the industry as we speak. We know it's being closely observed by many other stakeholders, because to my knowledge, I think we're the first supervisor who tries to establish a sort of a more specific supervisory framework, call it defining a new normal on how any particular company should cope with green financing related issues along various management dimensions, let me call it that way, like strategy, like governance, like risk management, like certain product related issues, and so forth, transparency requirements. To be honest, it's a learning curve for everybody, not just the industry, for us as well. That's why it's legally non-binding. But we very much feel we've done the same 2 years ago on cyber risk, actually. I think we feel an obligation to provide more guidance to the industry and the interaction between supervisor and the industry to establish sort of an industry-wide framework on how to cope with that in day-to-day business. I mean, supervision takes place where the rubber hits the road. It is not general principles, it's not basic beliefs, it's where the rubber hits the road, so it has to be specific. I'm very curious to hear the feedback from the industry. So, yes, indeed, I mean, basically, as everybody knows, it's two basic things, both for banks, but for insurance companies even more so. Number one, it is about discovering hidden risk you may have in your book, in your asset book. Let it be transitory risk, let it be basic risk. You have to understand that. You have to cope with it. What that means in detail may be different from company to company, but at the very least, it is something you have to consider. And the second thing, of course, is based on taxonomies and other guiding principles. It is a way how an insurance company is about to invest, meaning putting money into green type of investments. So we don't have to go through the whole range of challenges associated with it, like green washing and green labeling challenges, the lack of clarity, the lack of real projects. I mean, most of you guys who are very much inclined to invest in that are complaining about a lack of projects, which coincides with my observations. So anyway, but those are the two basic challenges, and let me end with a little twist into Solvency II review. Most certainly, if I was just quite blunt and bashing on green supporting factor, I'm equally clear that Solvency II, as it stands today, has been overemphasizing the component of short-term volatility. Sort of in a way, regulatory correct way of discussing improving sustainable finance would be how to honor in an appropriate way, in a methodologically appropriate way, illiquidity premiums if you're an hold-to-maturity investor, what most insurance companies are. That indeed is inappropriately addressed currently in my thinking, and I am a regulator, in Solvency II today, so that should be within the 800-page torturing paper from Gabriel, which has left the room for good reasons probably, is something we have to address. And so that is not about deregulation. So of course you shouldn't talk to me about deregulation, that's very difficult. But it's about very prudent adaptations which are fully compliant with the basic principles of market-based valuation and market orientation, which I fundamentally believe is the right thing to do. But yes, the switch from Solvency I to Solvency II was something like going from Basel I to Basel III in one go. So that was a massive, massive step. So we shouldn't be surprised that appropriate adaptations now, as part of the review, should be on the table. So that would be, coming back to your question, I think a very appropriate component of that's not easy to operationalize, though. Let's be honest about that. That's quite challenging to do that, how to measure that, how to keep an eye on that. But as a matter of principle, I would think that is something we should tackle right away.
Gabriel Bernardino n'a pas été là pour vous entendre, mais je compte sur la FFA pour lui reporter vos propos.
You have said.
Puisque nous sommes sur le terrain.
Since we're talking about regulation, we speak a lot about regulations in solvency and prudential rules, but less when it comes to cyber risks and digitization. And yet, these are potentially emerging risks that are considerable and a strategic challenge with economic warfare between different geographies. If you were to send a letter to Father Christmas, what would you ask of regulators?
The first of all is to share the information. Share the information of all the incidents that is happening, because it is the way in which we as insurers can learn more and more appropriate, put good tariffs to this risk. Then the huge challenge, and this is the first thing that we did in Mexico last year. We have a very important attack to our central bank transfer system. And then and it was also one big company, European company, involved in this case. And the first thing is to share information in order to learn, to create the proper risk management. And this risk management has to be all the measures in force in order to prevent an attack. And on the other hand, the kind of reaction that you will put in force in the moment of an attack, whenever it is the different types of attacks, for example, the hiding of the database, or if it is a drawing of the information and the fraud that comes from that part. And the other part is how to reestablish the operation of the company. And in the case of us as insurers, we have to provide this kind of assessment to the customers, not only to take the risk from the part of the customers. We have to cover them, but we have to help them. Then the products has to be designed in order to be comprehensive products which allow the customers to have a proper risk management of cyber risk.
Pour dire quelque chose.
To say something that's a bit different, I would ask for the laws, existing laws, to be revised when it comes to digitization, for example, because I believe that there are elements in the current laws that create obstacles and barriers for digitization. Instead of setting up more norms, I would review existing norms to eliminate obstacles. When it comes to cyber risks, I would ask for greater sensitization, no regulation, but the public authorities and administrations must set up campaigns to promote awareness amongst individuals, industries, and administrations to know what are the risks that they may be facing. I said it roughly before. I would encourage companies to invest more in artificial intelligence. Actuarial schools and actuarians must work more on artificial intelligence to be ready to face competition from outside of Europe that will soon be coming. So in regulation today, but more or less, I won't repeat what was said elsewhere, and I don't believe in Father Christmas.
Well, I'm amazed, and I can guarantee you if that would have been a banking federation's assembly, the proposals would have been slightly more undecent. So congratulations for, as always, being a much more civilized crowd of people. Everything is granted and done by next Christmas. I think transparency is a given. I mean, that is, I really think that both from a European point of view as well as my colleagues on a national level, a very dialogue-orientated way of doing regulation, of improving regulation, of doing supervision is very much in our nature. That was certainly different 15, 20 years ago. So I think we have moved with the time in that regard. I personally can't picture doing that any differently. I share your view. I think there are lots of hidden regulations in general laws, not actually necessarily financial regulation. It starts with seemingly simple things like requirements on what has to be done in writing on paper. There are an amazing number of requirements, particularly court proceedings, for instance, so forth. A little thing already makes the difference between a seamless, fully electronic file and one little thing may spoil the whole thing because then you have to keep a paper-based trail separately. And trust me, we as an authority, who of course have to comply with such things as well, are suffering from that as much as anybody else. So I couldn't agree more with that. I can possibly add that the big opportunity we are having ahead of us is now the review of Solvency II in the insurance space. There are accompanying issues, I think it's been mentioned before, like on the conduct side, like PRIPS and certain other, the distribution directive things. They are not up for review, but Solvency II is. I hope we will make good use of it. There are necessary adjustments to be discussed. I'm a big fan of proportionality. I think we should dare to have sort of a most steeper slope of the spread, so to speak, between very risky and very little risk within Europe. And Pierre, that's something which maybe isn't always considered on a political level appropriately. If we in the EU, for good reasons, choose to conceptually apply a single rule book approach because we look at financial regulation as a means of harmonization in general, unlike almost all other countries in the world. The US doesn't do it that way, the Asians don't do it that way. We apply a single rule book approach in the entire financial industry, which I don't doubt. I think that's okay. But if we do that, we necessarily have to be more explicit in spelling out proportionality within that single rulebook approach. Otherwise, if it's only very little sloped, which is both true on the Basel side of things, the banking side as well as the insurance side, we have implicit unintended consequences for the middle and lower part of any particular industry in any particular country, which is very difficult. So I'm a big supporter of increasing that sort of sloping, which has to be built into regulation and give us supervisors more degrees of freedom, because obviously if it's in the law, we can't decide to just ignore the law. That can't be done. So we are pledging to please give us sort of a more sloped degree of flexibility, which is another point which I hope would be considered.
Le temps file à une vitesse, file comme l'éclair.
Time is running at the speed of lightning. Maybe just one question. I have a question for Madame Fauvel. Calling on computer experts, that is crucial. Now, the generations of of computer experts change every 3 or 4 years. So if you recruit someone, either you really invest in constantly updating their knowledge and skills, but there are natural limits somehow in terms of their ability to assimilate computer sciences. When a computer expert is very young, he enters a world that is framed by regulations and compliance rules. How do you manage the risk of an attitude that is, how would I say this, a bit like an anarchist that you find amongst the young computer experts who have a lot of qualities elsewhere in a very regulated environment such as what you find in insurance companies? A wonderful question. I face that every day with data scientists or people in digital. There are things we accept and things we don't. We have rules of the game. We're highly regulated. We're an insurer, not a startup. Let me give you my experience. When I recruit a person coming from a startup company, from Google or Facebook or those companies, the DNA never takes on. The person will reject the rules and regulations and compliance. And I still saw a case recently. One guy just slammed the door last month because he couldn't stand us being highly regulated. So I don't recruit that type of employee who's wonderful aside from that, because it's not the right DNA. So we can push the limits, but we are a regulated organization, so there are limits. So I recruit them when they leave school, or coming from competitors or large groups of the same size and that are highly regulated as well, because otherwise they're unhappy and so are we. So we get them right out of school. Now, when it comes to IT and mathematics, that changes every day. I was trained as an engineer. I did statistical, traditional statistics like many of you. You have to keep up to date. We have had mathematical technologies that has been around since 2008. You need to go back to school and learn. As leaders and employees, you must be trained throughout your lifetime today. And those who do not train themselves will just leave the system, I believe. It sounds simple to learn constantly, but I always tell my employees, if you don't learn something every day, you have wasted your day. It's like if you don't read a book a little bit every day, you have wasted your day. It's the same thing. Well, I've good and bad news for you. Bad news, I need to put a stop to this exciting round table panel discussion. Good news, a buffet is waiting for you.